into what I'll be talking about here. Oh, okay. Now the recording is on. I will
Yeah.
once again thank Patrick for the intro that wasn't on the recording, but for those of you on the recording, I have a slide for that in just a second. But it is a great pleasure to be here today, and I'll be talking about Introduction to Decentralized Finance. Let me go ahead and share my screen so that we can look at what all is going on here. And just a little quick reorg of my own screen, and we should be set. So for the intro that Patrick didn't record, I've been at Lehigh for quite a while, as you can see. I've been chair of the Department of Computer Science and Engineering. I have run our Lehigh Unique program in computer science and business. Big thing I'm doing right now is teaching and research in blockchain. Within the Business College, our Center for Financial Services, we have a blockchain lab that I direct. And yes, I did stuff before, as noted here, but if you do want to reach out to me, I've got my email address here, and we'll put that again at the end. So since you've just heard a bit about smart contracts, I'll be assuming that you've got the basics and launch right into what DeFi or decentralized finance is. And probably the shortest thing to say is that it is just finance. The difference being that instead of it being run by some kind of financial services firm that serves as an intermediary, a smart contract provides that functionality. And that smart contract can indeed be an autonomous organization. That is, it's running entirely based on its own code without any controlling input from a specific individual or institution. Now, autonomy doesn't mean no input. As noted in the previous talk, there can be input about the real world from oracles. There can also be a governance function that is crowdsourced. More about all that in just a bit. So why even think about disintermediating? Certainly, lower overhead, lower costs, but also broader participation. Playing in financial markets requires a reasonable degree of sophistication, also a reasonable degree of capital to make an investment. Even having a bank account is something that's not available to a huge number of people in the world. So lowering these barriers is certainly, not just cost effective, but potentially a social good. On the flip side, there are challenges, both regulatory and in terms of compliance with those regulations. Now, what I'm going to do today is not aim to dive deeply into any specific DeFi application, but provide an overview of some of the scope of DeFi, what it can impact, and the resulting benefits and challenges. Now, largely DeFi is running on Ethereum. It doesn't have to. It can run in any situation where a sophisticated smart contract can be written. And why Ethereum? It was the first to enable smart contracts. There's a rich ecosystem based on the ERC20 token standard that we saw in the previous talk. And so in the previous talk also, there was some reference to automated market makers. So the basic idea here is that the system creates a liquid market and offers an exchange between two tokens, cryptocurrencies, whatever, at a particular rate. And so for each pair, there's a smart contract that can take deposits and make trades. So if you're going to deposit into this pool to try to provide liquidity to the market, you deposit at the current exchange rate, which means that if this pool were, let's say, for token A and token B, you deposit value in both tokens, matching whatever the current rate happens to be. When a trade is made, that generates a price change. And this price change has to be done with care. If you don't do that carefully, you could imagine a situation where I come in and I make a trade. And then immediately I reverse that trade and turn a profit. Now, if that's the case, of course, I'll just ping pong back and forth and I'll drain this whole particular liquidity pool, and things wouldn't work well. So the algorithms are really important here. While we won't have time to talk about them specifically here, that's a very interesting area to dive into more deeply. And then another interesting algorithmic issue here is how depositors earn a return. In principle, this pair for the automated market maker is taking the short end of every trade. A trader comes in thinking this is a good deal, and the AMM goes on the opposite side. The profit comes from fees, but those fees also have to be limited. Otherwise, that takes away the incentive to trade in the first place. So lots of algorithmic detail here and lots of different examples. Uniswap is the biggest and best known, but there are a whole bunch of others. All are based on the same basic principle, but the underlying details differ. Now, another really cool idea in terms of how these systems are set up is how you track deposits. Now, normally in a financial system, if I make a deposit, that's recorded in a ledger for that institution. Or, if I go back to, my youth, if I opened a savings account, I would get back a bank book, a physical thing that represented my deposit at the bank. And that's more the analog of what happens here. If I deposit into one of these AMMs, I get back a token, another ERC20 token that represents my deposit. I can then turn that token back for withdrawal. But I can do something else with this token. I can trade it. And so the idea here then is that if I go back to the bank books of my youth, I can actually go and sell my bank book to somebody else. And then that purchaser now owns my savings account. Or I can sell some fraction of it. And so there's this interesting secondary market then on top of the market created by the AMM. And then there's the issue of governance. In traditional finance, the market is governed by various institutions. Here, the AMM is a smart contract. Now, the smart contract could be controlled by an institution, but for the examples that I showed earlier, they are decentralized. So what that means is the participants in the AMM actually control its operation by vote. How does that vote happen? That's governed by a governance token, yet another ERC20 token in this whole ecosystem. And these governance tokens get issued both to depositors and traders. So basically, any individual who participates in the whole business of this particular AMM gets some voice in its governance, except of course that governance tokens can be traded as well. And so I could in principle here deposit, let's say to Uniswap, get a token back for my deposit that I then trade. I get some UD governance token for Uniswap and I can trade that as well. So there are multiple levels of markets all going on here in parallel, creating an extremely interesting financial ecosystem. The same kind of idea applies to lending. So now instead of doing a trade of one token for another, what I can do is either deposit a token or borrow a token. The automated system sets the interest rates. So the interest rate I get on my deposit is set automatically, as is the offered lending rate. There are many players in this space. I list a few of them here. And model here very much similar to what I talked about in terms of AMMs for exchanges. And so if there's a lot of demand to borrow a particular token, then in order to attract more depositors to be able to meet that demand, of course, we have to have a situation here then where the interest rate goes up for depositors so as to attract more, etc. And all of these changes are happening dynamically in response to supply and demand. So if I want to borrow, what I do is I go ahead and provide collateral. And all loans here are over collateralized and by some amount. How much? It depends on what the particular collateral is. Depending upon the perceived risk factor, the collateralization factor will be different from one to the other. Now, as a borrower then, since I've had to over collateralize, we have the risk that at some point as market rates change, the value of my collateral relative to what I borrowed may change. And if these get too close, then we pass a certain barrier where my loan now comes available for liquidation. So liquidation occurs when the borrower is deemed to be insolvent because the amount owed is too close to the amount of collateral deposited. And as I said, too close depends on the actual particular tokens involved. When this barrier is passed, then it's opened up to liquidators. Liquidators are other users playing in this space who then go ahead and buy part of the outstanding debt in exchange for some of the collateral. Now, why would a liquidator do this? There's an incentive to do that. The specific incentive and percentage is a parameter of the different platforms. But the idea here then is that borrowers have the risk of being liquidated, but depositors get security for their deposit, knowing that if the market moves in a way that the deposit would be put at risk, there are liquidators ready to step in to provide security. And so this market itself is entirely automated. The players in this, we have the depositors, the borrowers, and the liquidators, and an incentive system to make all this operate and continue to run. There's a governance aspect to this as well, obviously. And just like before, players in this space get incentivized by being given governance tokens, and those too can be traded. Governance here is a really interesting thing because governance includes such things as setting the collateralization ratio. And if that's not set right to properly represent the risk for the different tokens involved, that may make the market here for both depositors and borrowers not work in an ideal way. So again, multiple levels of market and incentivization going on here. So for the two things I've talked about here, we have exchanges, we have lending, and multiple players in this space, as I noted. Obviously, there are arbitrage opportunities. One exchange might offer a better deal. One lending platform might offer a better deal than another. And so definitely big arbitrageurs can come into play here, take advantage of it, and earn a profit. But what about small players? The whole ethos of blockchain is the idea of decentralizing, letting all the small folks play. And that's where yield farming comes in. So yield farming is the idea of exploiting arbitrage, but the yield farming platforms allow small players to make deposits into a yield farming operation. And then those deposits are aggregated and invested based on some particular algorithm to seek out return across a variety of platforms in the DeFi space. There are a number of these, Yearn, Harvest playing on the yield farming theme, and a variety of others. And so yield farming then is a whole additional market on top of all the markets I talked about earlier. Now, this is all not without risk. All of these various systems I talked about are smart contracts. Each one of them has the potential for having a bug or be vulnerable to some kind of attack. Now, smart contracts are on the blockchain, they're public. If you're worried about them, you can look at them, you can audit them. And also, just like any open source software, there's an ecosystem of folks who do look at these things and validate them. So there is some confidence that comes from the crowd looking at all of these things. But vulnerabilities exist. And for unaudited contracts, they might have had designed in openings for some unscrupulous player. So there's a good bit of, shall we say, trust but verify going on here. And the levels of risk here, of course, grow. If you're up at that tough level of yield farming, you've got the risks of the yield farming contract. You've got the risk of all the underlying contracts in which the yield farming algorithm invests. Now, in the financial system, of course, where things go wrong, there are lawsuits, the courts, regulators, etc. In blockchain, transactions are immutable. So once they happen, they've happened. And if we have a situation where some trades are done without KYC happening, there could be absolutely no legal recourse for the various losses. Another layer of risk is simply system performance risk. I mean, we see this in any kind of automated algorithmic trading system. You want to be close to the exchange in the stock market to get your trades in the fastest. Here too, there can be system performance risk, both in terms of overall network connectivity and demands on individual blockchains. Going way back now, the Ethereum CryptoKitties fad is one example of a case where there's this sudden massive demand that can have impact on all of these strategies. A very recent example of something that actually did go wrong was the hack on Cream. So Cream is a DeFi platform, and it was hacked only, I guess, like a couple of weeks ago to the tune of 130 million. But actually, the hack could easily have stolen about $1 billion if there had been $1 billion there to steal. It basically took everything that was there for the taking. Very sophisticated attack. And while I won't go into the detailed step-by-step of what happened, a key component here is a very interesting concept called a flash loan, something that you don't see in the finance world, but you see in the DeFi world. And the key thing with a flash loan is the idea that I can create a transaction that's going to take a massive unsecured loan. Now, what? You wouldn't give anybody a massive unsecured loan, but you do it here because within my transaction, I take the big loan, and at the end, I pay it back to you with interest. So it's a good deal. It's a good deal because if my transaction runs, you make money on the loan. On the other hand, if something goes wrong, the transaction reverts and never really existed. So this unsecured loan represents a absolutely wonderful risk for the lender. So now this transaction has this huge amount of borrowed funds that it can use to make a market-moving trade, thus creating an arbitrage opportunity that this transaction immediately exploits. Exploiting that arbitrage opportunity, the transaction now has the resources to pay back that original unsecured loan with some interest and still earn a significant profit. So this was the root source of the Cream hack and other hacks that have gone on. There are certainly defenses against this. And so the hack I'm referring to here had lots more going on to hide this and evade various defenses. But it shows here that there are unique risks in this space that have to be understood, but unique opportunities, as I said at the beginning. The idea that we can run operations like exchanges and loans in a totally automated situation, no overhead, automated markets, creates a huge opportunity for efficient finance, and something that is very clearly happening globally. Various governments are looking at it from a regulatory perspective, but it's something that's definitely on the way. I'll be leaving a bit of time for questions before I stop, but before I get there, I want to make reference to other applications of blockchain technology generally in the finance space. So that's not DeFi per se, but audit is an interesting example. If the data for a company is audited right now, that's done by an auditing operation that writes a report. In the blockchain world, it is possible to construct mathematical proofs of certain properties of corporate books without actually revealing the underlying data. The key technology here is something called a zero knowledge proof, and another fun thing to dive into in terms of future applications in the finance space. There are a number of players in the foreign currency exchange business, most notably Stellar and Ripple. Various other activities like frequent flyer miles could indeed be viewed as private currencies. They could be cryptocurrencies. They could be combined in a sophisticated system within a blockchain framework. And then, of course, there's just general commerce, which leads to the huge area of central bank digital currencies. Many major nations and minor nations are looking to create a digital version of their fiat currency. And that's another whole huge and interesting domain for finance within the world of blockchain systems. And so with that, I'm going to pause and hope for some questions. I see at the moment nothing. I see one in the Q&A, and that's question is, what's my opinion on crypto native stable assets and their staking, and then also value of the utility tokens. So let me say something about both of those and the idea in terms of stable assets. Well, stable is a relative question here. Even though an allegedly stable asset may move a little bit, well, that creates arbitrage. And in fact, a number of stable assets actually maintain their stability, not through some kind of external backing, but by algorithmic reliance on arbitrage to keep the particular stability peg. So it's not just arbitrage as an opportunity, but in some cases, arbitrage as the way things work. And then these various utility tokens that serve a whole variety of purposes, including governance, et cetera, and the trading of these. The overall idea here is that what we're trying to do is allow the crowd to rule the financial system as opposed to financial leaders. And so how valuable is that? How much is it worth for me to go ahead and spend my own resources to buy the ability to vote on the governance of any of these things? And that then leads to, how do I govern to personal advantage? And how does that collective personal advantage turn into a centralized good? Now I see a couple of items in chat here. Oh no, the chat questions are just internal. They're not questions to me. So as we look for some more questions here, I will, as just a final thing before I conclude, give a quick summary of all the blockchain stuff going on at Lehigh today, which largely focuses, as you might expect, on teaching and research. So we've got 3 blockchain courses going right now at Lehigh. Perhaps for this group, the most interesting one would be the last one here on this list, the one CSB 442, which is targeting the Master of Science in Financial Engineering program. At the undergraduate level, we have both a pure computer science class, which is this one, and one that bridges computer science and business. The CS one going into all the underlying tech, while the business one focusing on policy and business applications. On the research side, things I've mentioned here, you see coming back on the research activity we're involved in, central bank currencies, both in terms of policy and system architecture to build one. We talked about some of the possible abuses like flash loans, and that leads to the issues of blockchain governance. And also, I mentioned the use of zero knowledge proofs. They turn out to be efficient to validate, but costly to generate. And we're looking at algorithms and techniques using modern architecture to accelerate zero knowledge proofs. And I see that in the Q&A here, which I don't know is public. Can everybody read this? I'm
yes.
going.
I mean, the panelists only, yes.
Oh, okay. So the panelists can read it, but not the audience. But we have comments here about Olympus being backed by a treasury, and then using the same model as a central bank. And an important point here, and one that if you look at the spectrum of the big stable coins like USDT, USDC, and MakerDAO, you have 2 that are backed, or perhaps I should say allegedly backed, given all the noise around Tether, by some kind of reserve assets. Maker is interesting in that there is no actual reserve, but rather there is an algorithmic system of crowd provided backing to create the underlying stability. And there's also a very Lehigh internal question in the Q&A, but I know that a lot of our audience is Lehigh. So for those of you outside, I'm going to ask you to excuse me for answering this question, which is the CSB 242 class that I noted here a moment ago. And this internal question is this available only to students within the Lehigh Unique Computer Science and Business program? And indeed it isn't. It is open to everybody at Lehigh having the prerequisites. So to the person asking the question, absolutely. And the reason for these various designations is that we use our computer science engineering designation for purely tech courses that are technical electives, and computer science and business, one of our flagship intercollegiate programs, to show that it's actually indeed intercollegiate, open to everybody. And I will.
Thank you very much, Hank. Again, thanks for all your help for the program. I mean, there's no blockchain project without you. I have to keep saying that. Make sure it stays and remain.
Thanks a lot, Patrick. Looking forward to the rest of this conference.
Yes, definitely. Okay.